Sometimes I get asked, what is the risk that involved with commercial real estate? Isn't a commercial real estate very risky? Because most people that I know, they are residential real estate investors and they own rentals nearby, and that's something they can see, they can touch, and something they actively manage. So if they feel it's very safe and that's something they know, so they think commercial real estate is much risky. But in reality, the residential real estate is not as safe as you may think. And for example, if you own one rental and this rental is vacant, you have a loss of 100%. If you own two rental, one is vacant, your loss is 50%. If you own three, one is vacant, then your loss reduced to 33.3%. And if you get 10 houses and one is vacant, you're not going to sweat too much because your loss reduced to 10%. Imagine if you own 100 and 200, and what would happen? Your vacancy, it's only 2%, 5%, and your loss is drastically reduced. And so that's, in that sense, commercial real estate, commercial multifamily, it's much safer. And let's look at this chart. That's when operator, when they decided to purchase a multifamily unit, a multifamily complex, and they will do all kinds of underwriting. One of the analysis they will do is called the sensitivity analysis, and basic to see what is the risk that involved with this typical assets and what is the break-even point. Basic is past this point, the investor will lose money. And let's look at this project, Highland of Preston, is a 340 units multifamily community that we purchased last year. And this is also located in Dallas, Texas, a booming area. Let's look at this chart here. On the top here is net cash flow, monthly base. And on this side is the occupancy rate. And let's look at here. When they purchased this project and the occupancy rate is at 95 and the return at 7.8. The projected first year, the return will be 8%. And let's look at it here. If you increase the net income 1%, that's your return increase from 7.8 to 8%. If your income rate increase 2%, then your return will increase to 8.1, 8.2, go on. And so the whole business plan is to purchase a stabilized project with rent under market. And as the unit turn tenant leave, we will renovate the unit and bring the rents up to the market rent to increase your monthly rent revenue, and in return to get a higher return. So in 5 years, and when the return gets certain points and your revenue gets certain point, then we will sell this project to get the big profit. And then let's see what will happen, the risk, when economic is going down and there's a crisis. Let's see, your revenue dropped 1%, so your return will suffer 2%, and your return will be 7.4. Let's go all the way here. If we go all the way top here, if our vacancy, your occupancy at 81, that means your vacancy at 19%. Just for this simple, let's see, your vacancy is 20%. That means in this community, 20% of your total units are vacant. What happened to the investor's return? Let's look at this number. at 3.6%. At 20% vacancy, and investor did not lose all the money, and only thing happened to your return is your return dropped to 3.6. So what is the break-even point? Let's look at here. They run this project, they find the break-even occupancy at this project is 59%. In another word, the break-even point vacancy is 41%. So if the total vacant unit reach 41% and your total return is 0, that means the project only have enough cash flow to pay the debts, the mortgage, and the expense, does not have any money to pay the investor. And if your vacancy reach 42% and beyond, and that's when the investor will lose money. Okay, so now we're talking about lose money, and then we'll see what would happen to this project and will have the 40% vacant. I have to say, it's almost impossible. That is why one of the reasons we're choosing Dallas, Texas to invest, because Dallas in the past 5 years and has been ranked top 10 in the nation in the employment, occupancy, employment, and the population growth. And every day there's 1,000 people, new people move into Dallas, and there's actually a shortage of housing. So the vacancy most in the area, the vacancy average between 90% to 95%, similar assets. And then let's see, in the downtown, in the area, certain assets, the worst time in 2008, and their vacancy reached to 20%. This project has never seen that, and let alone 42%. If it's a project had 42%, that means maybe the sky is falling, and the whole, not just the area, the whole nation is down. And so that's, you can see the risk is relatively small. Don't you agree? So let's also look at your investment. And if you invest 100,000, and this is a projected return, so we are actually well ahead of the project as this project, as I'm recording this. And so you have to the year 5, that's when we're going to sell the project. And say here, they break down if you invest in $50,000, and that's so forth. So that's the I wanted to share with you the multifamily. It's much safe than you may think. Okay, thank you.